I'm Charlotte McLeod with the Investing News Network, and here today with me is Adam Rozencwajg, Managing Partner at Goehring Rozencwajg. Thank you so much for being here online with me once again.
Thank you so much for having me. Good to be back.
Yeah, it's great to have you back. We last spoke a few months ago and we focused on copper. Today, we're going to go in a different direction and look at uranium. So, I wanted to start out with looking at demand. This is a market that our audience definitely has a big interest in. And when we look at demand, we often hear a lot about utilities, but it's quite opaque. So, I wanted to start by getting your thoughts on demand. And when you look at uranium demand, what are the factors you're considering? How does it work for you?
Sure thing. Look, the uranium market is really different from any of the other commodity markets that I look at in the sense that there's really not a lot of available data. And the market moves slowly. There's a certain number of sellers, there's a certain number of buyers, and it happens. It's a very clubby atmosphere amongst uranium traders. And it's very different from, say, the oil market, where we get a huge wealth of data. In the US every Wednesday from the Energy Information Agency, or the EIA, and then once a month we get all this data from the IEA. And it's still very, very difficult to get right, but at least there's a lot of data out there. When it comes to uranium, I think we have to take a little bit of a step back, look at a bigger, broader trend, a bigger picture, and sort of see where things are going, in terms of large supply and demand movements. And so what we see there is we see a market that has been so depressed for so long that really the two major incumbents, Cameco in Canada and Kazatomprom in Kazakhstan, have both been forced to curtail supply during this cycle. Prices gotten so low that even on operating mines and operating in situ leach facilities in Canada and Kazakhstan, respectively, the two major incumbent players, with all the scale in the world and with all the low cost in the world, were forced to shut in production. That's really dramatic. Normally in the resource world, you're talking more about what is the price needed to incentivize the next generation of mines to come online and offset depletion in the old mines. Very rarely do you actually eat into the cash cost curve in the way that you did with uranium. So you have this supply picture that's very, very, very tight. No new operations are coming online. Nothing's been sanctioned. And when you look at the sort of new projects out there, most of them need a uranium price that's double the current spot price. And so we've never really seen, in my career doing this, a commodity market that's so below the incentive price needed for long-term equilibrium. And the reason that that has been the case is that we've seen big shifts in demand over the last 10 years after Fukushima. Japan idled a huge amount of its reactors for basically a decade. They're just starting now to potentially bring some new reactors back online. And large parts of Western Europe and the United States, for that matter, have retired some of their legacy nuclear reactors. So that's hurt demand. And in the offsetting that has been a really, really sharp increase in both planned, proposed, and constructed reactors coming from the non-OECD world, China and India. And so when you put all those things together, what you end up with is a market that I think has been neglected for a long time. It's a market that has basically bottomed and tightened starting 2 years ago. We've been running a massive deficit of primary uranium for the last 2 years. And I think that now it's going to start to work its way into higher prices.
Yeah, definitely so much to unpack there. Sticking with demand, you've mentioned some factors that hurt demand in the last decade or so. I think people are quite familiar with those. As we're emerging from COVID-19, we're starting to hear more about a green recovery where we would have more environmentally friendly processes to produce energy. How do you think that impacts uranium demand potentially?
Well, I think that we firmly believe at Goehring and Rosenzweig that the only way that we can move forward with a low carbon, abundant energy world is through the widespread adoption of nuclear power. So whether or not people wake up to that or not, I think will be a matter of time. But if you're serious about wanting to reduce CO2 emissions, there's really no other way that you can do that other than uranium and nuclear power. And to understand why, I think it's really important to understand this idea of energy return on energy invested, or energy efficiency. So for every joule or kilojoule or megawatt, what have you, of energy that you put into coal, for instance. You're going to liberate 30 times that amount of energy in the form of usable electricity. That's really, really impressive. And that leads to huge surplus energy consumption around the world. The problem is it generates a lot of CO2. So when we look for something to replace coal, we could look at gas that's nearly as efficient, generates half the CO2, but still people want to reduce that CO2 even further, all the way down to zero. And to date, people have really embraced solar and wind in order to do that. But when you factor in the total energy cost to generate that solar and wind power, you're talking about going from something with the energy rate of return of 30 to 1 down to something as low as 4 to 1, or even lower in some cases, depending on where you put them. So when we think about carbon-free power, we think about something that emits no CO2 at the source and has a better or as good conversion of energy into new energy, or energy return on energy invested, as what the legacy technology, namely coal and gas, are. So coal and gas are 30 to 1. You need to beat that and do it with less CO2. Nuclear power is 100 to 1. So it's the only thing out there. Even if CO2 weren't a problem, we should be going towards nuclear power because it's 3 times as energy efficient. However, CO2 is a huge concern, and nuclear ticks that box as well. So I think that that's going to be a huge, huge driver, the most important going forward.
Right. And, you mentioned people should be looking at uranium, but we don't know yet if they will. So what are you seeing so far in terms of changes in perception? Are people and governments around the world becoming more accepting? And where are we seeing that?
It's a great question. So I think in terms of perception, and this is a little bit, of a softer data point, but in terms of perception, I think we're seeing a big change. If I just read the op-ed pages of newspapers, people that I would have in the past thought would have had a anti-nuclear stance are now developing a little bit more of an affinity for nuclear energy because of its green properties. So whereas before I think nuclear was thought of as dirty, I think now it's being thought of a little bit more as clean in certain circles. But where it really matters is going to be in the government policy side of things. And there I think we're seeing 2 really important initiatives, one in the United States and one in Europe. So remember, the major sources of demand growth going forward are going to be from China and India, but obviously Europe and the United States are important too. And in the US, what we're seeing is talks of extending the life of several nuclear reactors past their original expected lifespans because they're able to continue to produce safe electricity. And so their permits need to be extended. We're seeing the beginnings of change in sentiment there and allowing that to happen. I think that would be a little bit of a signal that the current administration is probably thinking about nuclear in a part of the solution for CO2 going forward. And in Europe, what we're starting to see is new climate proposals being put together now and being debated as to whether nuclear should form part of that or not. And so we're in the process of negotiating a major new framework now. The EU member countries are split. The last I heard, I think there's 1 or 2 in favor. The balance goes in favor of nuclear, but they're basically split whether or not the countries would like to see nuclear as part of the quote unquote, approved part of the plan to emit less CO2 over the next 30 and 40 years, or whether natural gas to replace coal is going to be part of the plan. We frankly think that both should be part of the plan, and I'm not really sure. I think it's sort of a false dichotomy and a false choice people are being forced to make. But clearly the countries that have just finished decommissioning all of their nuclear power plants are very, very adamant that gas be included and nuclear not, because it would put them at a big disadvantage, and vice versa. So there's a lot of politics involved, but I think in Europe you should watch for this new climate framework and whether nuclear is included in it. And in the United States, whether or not these permits for these operating permits of existing plants get extended past their original expected lives.
Okay. Let's move over to supply, which can also be a little tricky, just like demand. You were mentioning before, we've seen some major companies go offline or reduce their production in recent years. So can we start by getting a breakdown of what uranium supply looks like today? And I think first focusing on primary supply.
Yeah, sure. So on a primary supply basis, you've seen major curtailments from Cameco and Kazatomprom, and you have a major deficit of about 35 million pounds of supply relative to primary supply relative to global demand. That was true last year, and it was true this year as well. Now, the big question then becomes, where do you make that up? Well, you make it up from Cameco maintained commercial inventories. They had talked about not wanting to take those commercial inventories down. They were sort of adamant that they needed to keep those at a certain level. They weren't interested in curtailing supply and selling down inventories. And yet, they felt the need to do that. Basically, they had contractual obligations for more material than they were producing. They felt that they could go into the spot market and buy that material to be able to deliver it into their contracts. And instead, their commercial inventories came down. So those inventories now stand, I think, about 7 million pounds, if my memory serves. If you look on the Kazatomprom side of things as well, their commercial inventories are less well discussed. However, those were drawn down as well, and now stand at a point where the rhetoric from that company is that they're not looking to reduce their supplies, or not in a position really to safely reduce their supplies either. And so then you ask, well, where did the remaining material come from to make supply and demand meet for the last 2 years? And they basically come from utility inventory. So most utilities do run a certain amount of inventory, both in the form of finished fuel rods as well as just U3O8. And if you look back, historically, I think the average has been approximately 3 years of inventory, and that corresponds basically to the fuel cycle. Right now, inventories stand at about 4 years, and they were a little bit higher before. So that has been worked off. At some point, presumably, that needs to be reestablished. However, I think when you a lot of analysts, when they look at demand and they look at supply, primary mine supply doesn't meet global demand for uranium. And so the question has always been, where's it all coming from? And it's always been these secondary sources of supply. It used to be nuclear weapons that were being stepped down to form usable material for power reactors. Then it became reactor underfeeding. Now it's utility inventory. So like I said before, it's an opaque market. It's very different. The way we think about it, we try to take the big picture. We try to look forward as to where things ought to go, and we see a tight market ahead. But it is much, much more opaque than, like I said, most other commodity markets.
Yes, definitely. And talking a little bit more about the secondary supply, we heard for years that there is all of this overhang due to the Fukushima incident. And maybe we can talk a little bit more about companies this year. We've heard some smaller companies buying from the spot market. We've also had the Sprott Physical Uranium Trust launching this year. So how does all of that fit into the picture here?
No, they're all great questions, and that was the big mystery for so long, is what happened to all this material from post Fukushima. The Japanese largely stood fast on their contracts and accepted delivery of materials that they were contracted to buy. I think in most other parts of the world, you might expect to see a force majeure called, and the company tried to walk away from those contracts, but the Japanese basically took all the material, or a vast majority of the material. There's been a lot of questions as to where that material has gone. Some indications suggest that it has been slowly bled into the market. Some people think that it went into China as part of their ramp up, although I think that is unlikely at this point. But I think a lot of that material has been absorbed. It's difficult to get your hands on the numbers precisely, and I think not to go in the weeds too much, but I think there was a little bit of recent weakness in uranium price, and I heard that was a Japanese utility selling a little bit. But that's the sort of thing that people often say when they can't figure out who is selling and who is buying. But I think the truth of the matter is, when you look at some of the other indicators in the uranium fuel cycle, including the enrichment capacity and things of that nature, there's some indication to suggest that the primary U3O8 physical market has gotten quite tight over the last 2 years. And I think that that's probably right. As far as the Sprott vehicle, and as full disclosure, in both our separate accounts and in our mutual fund, we do hold that security. That was formerly the Uranium Participation Unit. Sprott acquired that earlier this year, rebranded it. They did make some changes to their corporate charter. Some of the stuff is frankly over my head in terms of the impacts. There's the ability for the vehicle to now more easily raise new assets and acquire more uranium. But the important thing for your viewers and listeners, I think, to understand is that is a closed-end fund. So the GLD, for instance, is the vehicle that tracks the gold price. That's an open-ended fund. People sell that out, and all of a sudden that sort of hemorrhages gold back into the market. It becomes a source of supply. These uranium vehicles should not, they're closed end. So basically, once money gets into that vehicle and it goes out and acquires the physical uranium to back the investment, that material is, for lack of a better word, trapped in that vehicle. And so clearly over time, you could envision a situation where, that becomes maybe a bit of a strange distortion, all this material stuck in these financial products. But for right now, what it means is that you have a dedicated buyer who's not really going to be a net seller under any sort of normal conditions. Even if people sell off that product, it'll just trade at a discount to its NAV, but it will not liquidate material. So that's been a huge source of new demand over the last year or so, and I think that's contributed to some of the tightness in the market.
Right, and of course, price is always a hot topic when it comes to uranium. Everybody wants to see a higher price. I wanted to ask what you think would be the incentive price to bring some of the idled production back online, and is it the same price we would need to see if new companies were to start bringing production online as well?
Well, so I think I'll start with your second question. I think the price needed to bring new supply, new mines online is probably $70. And the reason I say that is if you look at some of the PEAs of, the higher quality next generation, of which next gen is a next generation uranium project. So I don't want to confound the two issues. And I should point out that the fund, again, for disclosure purposes, we do own some next gen, although we don't own a lot of the other, really any of the other uranium junior mining companies, but we do own NextGen. That tends to be the price that I think would make those projects work. And there's a little bit of, I haven't looked at their most recent feasibility studies across the board. Maybe some are claiming lower, but to be perfectly honest, having studied those projects for years and years, and knowing how reluctant the banks would be probably to fund a lot of those projects today, given the weakness in uranium price over the last decade, I think realistically nothing is going to come online until you've had seen $70 price, and until the banks think that that's probably sustainable. I'm sure somebody will disagree with me in the comments or whatever, but that's sort of my view. As far as what's the incentive price needed to restart production at Cameco and Kazatomprom, that's obviously a little bit trickier because there's a lot of sunk cost there and things like that. I think from Cameco's perspective, I think there is sort of a strategic view of not wanting to sell out a global world-class asset right at the bottom of the market. So, I think there's some discipline there, and we'll have to see how that plays out over time. With Kazatomprom, it's hopefully the same, a little bit of an open question. The CEO was recently replaced, and so I think until we sort of get a little bit more color and clarity, some people are a little worried about what that might mean for strategy going forward. But we'll review that as it happens. I think we're probably still in an environment where supply discipline is in place.
Okay, and another kind of a two-part question here. So we've been hearing for so long that the uranium market is due for a turnaround. What do you think is holding it back? And then the second part is these price levels that we've been discussing. Do you have a sense of when we may get there?
No, and I don't know. Look, uranium is befuddled investors for a long time. And I think that post Fukushima, there was a really strong headwind in the form of continued nuclear reactor closures and a shrinking end user market. And I think that's a strange world to be in. Most commodity markets don't shrink in a demand perspective over a long period of time. And, you basically removed all the players in the global uranium market except for the two incumbent producers. And so, you've had a massive consolidation and a massive rationalization of the industry over basically a decade. And now you're making this really complex sort of bumping, muddled bottom. And typically what that tells me is that the bull market it's setting up for will be that much stronger and more stable and resolute. But You know, similar to copper a couple years ago, you know, we were out telling the copper story in 2015 and 2016, and copper bottomed ultimately in the end of 15, beginning of 16, at, you know, $1.50 or whatever it was, and kind of bumped along the bottom for a while. And everyone said, well, you know, you look at not a lot of new supply coming online and demand should be strong. And, you know, why aren't prices responding? And then all of a sudden they did. And so sometimes I know people want a better answer than that. And we tend to be early on everything. And we have been, you know, for the 30 years that my partner Lee's been operating, but we're always early on stuff. And timing is not our strong suit. So I think it'll come. I think the different levers are moving in the right direction. I think the market's tight. You know, it is a market that's in primary deficit, as I said, by about 35 million pounds a year. Pretty dramatic. You don't see that too often for a sustained period of time, but again, because uranium's a little opaque, because it's not, you know, this quoted followed market, you know, I think the weighting in the indice in the United States is zero. You know, it might take a little bit of time, but you know, we're patient investors, and we're holding a very strong, sizable position in uranium in the fund.
Right. And you're right. It is so hard to predict what's going to happen, but there is such strong interest. From your perspective, what's the best way to approach it from an investment perspective? Should you look at these larger companies that have managed to stay in operation through these downtimes, or should you be looking at smaller companies that may have a lot of growth potential once things do get going?
Well, everyone has a different investment risk profile and things of that nature. The way we like to look at it right now, we're sticking for the most part with the larger companies and with some of these vehicles that can get more passive uranium price exposure, things like the new Sprott fund and stuff like that. And the reason for that is the question we like to ask ourselves is if we're right on the uranium price, or any commodity price for that matter, and let's say long term, you know, with all the 10, 15-year demand from the emerging markets and looking where the cost curve is for existing supply, I think $75 to $100 is probably a long-term sustainable price. So let's say $75. So, you know, we set our price targets by saying, what if uranium does what we think it's going to do and goes to 75? Where's value in the space? And clearly value in the space, there would be with the smallest guys that are, you know, really out of the money. Their projects don't go forward today, trading at cents on the dollar. And then if you got a big rally, they would go up, I don't know, 10, 20, 30 fold probably. However, if we're wrong on the commodity price, what's the value of the assets? And if we're wrong on the commodity price and uranium stays at 30 or it goes back to 20 or God forbid goes down into the teens again, you know, Cameco is still an asset. It's still a company. You know, Kazatomprom is still a company. The uranium participation unit and all those, or the new Sprott, I mean, those will go down. Certainly they won't be good investments, but there's still an asset there. And so that's the tension that we like to build. We like to look at the upside potential against the risk if we're wrong. And so under that metric, we prefer the larger guys right now. I think there'll be time to own the smaller guys. For people that are really speculative and want a flyer, you probably could try to buy some of the smaller, more junior guys, a basket of them in case whatever, try to pick the best, however you want to do it. For us, we're sticking with the higher quality names, the larger existing producers for now. And then as the bull market unfolds, you know, we'll leave some return on the table and then begin to move into some of those more development names. But, you know, whatever we do, I'm sure we'll be wrong. You know, if you don't go speculative enough, then things will go up. And if you go too speculative, you'll have a huge correction or whatever. So we try to in this stage, in these bottoming processes, try to stay with names that have some downside protection. And then we'll look to add, you know, a little bit more as time goes on.
Okay, well, I think you've given us a great overview of what's going on in the uranium market. As we wrap up, I wanted to ask if there's anything else you would add on what's going on in the space, and maybe you could give the audience an idea of where to find you if they want to learn more from you.
Yeah, absolutely. So, you know, please go on our website. We publish a lot of content. We put out our quarterly letters. We put out a series of videos. Everything can be found at GOROZEN.com, or Goehring Rozencwajg is the name of the firm. You know, I think that it's an incredibly bright future ahead in the uranium space. I think that, you know, just given the realization that people, so much time and attention is being put onto ESG right now. And I think, you know, the first step in terms of investors' changes in the last 5 or 6 years has been, you know, adding ESG as a criteria. Now, the next, I think, iteration of that will be that people become a little bit more nuanced in their thinking and say, well, yeah, we all care about this, that, and the other, but how do we actually go and achieve those goals? And what we thought was, the solution might not actually be. How do we have an honest and open dialogue? That's my hope going forward. And I think uranium is the huge beneficiary of that. And then I think as, we continue to have more demand for energy across the board from the emerging market, I think there's a realization there that that uranium needs to be part of the solution. And then if none of that works, the ace up the sleeve or whatever is that some of these larger Bitcoin miners, as they have become under a huge amount of pressure for their carbon emissions, they've been asked to clean up their act a little bit, particularly if they're trying to raise money from a big North American bank or European bank who cares about these types of things. And so they said, why don't you go out and generate your power with renewables and use that to power your server farms? And very quickly they came back and they said, no. If we're going to want to really mine Bitcoin and care about carbon emissions, it has to be nuclear. So, we're not a crypto people, but, I presume that most crypto miners are extremely cost conscious and know what works and what doesn't. So, if China and India can't convince the world, and if the think tanks here can't convince the world, maybe the Bitcoin miners of the world will convince everybody.
Okay, very interesting point to end it on. Thank you so much for being here today to talk about uranium.
Thank you so much.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Adam Rozencwajg.